Happy Friday, everybody. I hope you had a great week. It's been another week for the history books. Today is the 28th of January, 2022, and this is your Friday planning video. Hope you got a chance to see yesterday's market update video. Of course, it was a special video for the week. I will definitely go into more in-depth of what happened during the week with the market update video on Monday, but I thought it was prudent to get a little bit more information out to you with the turbulent times we've seen in the markets. So I'm very tempted to use today's planning video time to do more on market updates, but I'm going to hold that out till Monday. So let's get into some ideas of what we can do with planning. Let's talk about what we can do from a planning perspective when the markets are down. So you've heard me talk about this many times before. I've mentioned that many people don't think that stocks actually can go down. So let's start there. This week proves it for us, of course, as did early 2020. Markets and even stocks of great companies can go down. As much as I want to go in depth into that information today, I'll leave that for the market update videos. So there are things that can be done to take advantage of market downturns. This should be obvious. Insert your optimistic sayings here. The sun will come out tomorrow. When the world gives you lemons, make lemonade. Whatever you want to use here. There's a few things that we can that we need to address in this market when the market is down. So a few are obvious and a few aren't obvious. So let's talk about them. First, increase your investments. Now this is the hardest one. It seems counterintuitive, but it's not. Remember, as long as your time horizon is a long-term time horizon, you're getting these investments on sale. I'm not going to tell you you're at the bottom because I wish I knew exactly where the bottom was. But in general, we're looking here, especially in retirement accounts, that if you have the ability to raise your contributions in your retirement accounts now in either percentages or dollars, it's a great idea. The younger you are, the better the strategy. Again, make sure it fits in your overall cash flow and your overall strategy. Rebalance the portfolio. Okay, I'll admit, this one shows up on every list I give you, right? So when the market's up, down, or sideways, rebalancing portfolios that have become a little off the rails when it comes to your risk tolerance and your goals, always a good idea and it's always appropriate. The benefit here, again, is that when you can go in and buy certain asset classes or assets themselves, you're getting them on sale. Now, there's no question the best thing to do for this is with new money. You can also use sales proceeds of some stocks that have not come down as far as some of the other ones. So either way, it should be reviewed at this time. Now remember, I don't give personalized tax advice, and I do recommend that we pass any of the following stuff that I'm going to talk about by your tax advisor. So here's one that will require a little bit more work. We've spoken many times about Roth conversions and getting more money from your traditional IRA into your Roth IRA. So we know that that's a taxable event and you'll pay income taxes on that move. But think about this. If you have that $50,000 traditional IRA, and that's where it was 2 months ago, and it's now a $40,000 traditional IRA, and you want to move that into a Roth, and you think it's going to go back to 50, convert it now, pay the income taxes on your $40,000, and then not the $50,000 that you would have done a couple of months ago. And now, if that account does go back to $50,000, that $10,000 was tax-free growth because it was in your Roth IRA. So again, if that's not clear enough, let me know. Let's talk about it. We can go through your individual situations. And again, I've told you with the changing tax laws that are out there, I think it's prudent to have money in all the different tax buckets. That's taxable growth, that's tax-free growth in Roths, and that's tax-deferred growth in traditional IRAs. So again, just depends on what we can do there. Let's see what that's. Now is a good time to at least have that conversation. Here's another one that falls into the tax camp. Tax loss harvesting. Now, it's been hard to find stocks to sell recently that you didn't have a huge capital gain in. Well, unfortunately, the most recent rapid descent of stock prices has changed some of that. If you didn't want to sell and take a huge tax gain, there's a silver lining to the gray cloud of these stocks coming down. So just as you did at the end of last year, it's time to look at those gains and losses, see if it makes sense to sell some of those losses. Remember, if we do sell those losses, the wash sale rule comes into play, and we have to stay out of that stock for 31 days before we buy that name back. So finally, let's get the kids and grandkids in on this action. If your estate plan is to get some of your assets out of your estate into your kids and grandkids' estate, limits on annual gifts continue to be in place. But again, keeping with the conversation, the math we did before, if you had $20,000 in stock and that's down to $15,000, and you believe that 15 is going to go back to 20, gift it now in the $15,000 gift exclusion. Move that into your children or grandchildren's account. Let that $15,000 to $20,000 increase go in their estate and not yours. Again, this is a little bit more complex in the estate planning side, so let's make sure we have a little bit more discussion on that if you want to do that. Let's talk about charitable gifts. We talk about that a lot. We know that gifting does not stop when the market goes down for most of us. And I do believe that you should use appreciated stock or donor advised funds for gifts when appropriate. So stocks are down, less value in that appreciated stock. Is this a good time to continue to do that? Let's talk about that as a strategy. Does it make sense to use cash versus this now less appreciated stock? Again, let's talk about it, find out what's what. Finally, this is another one that shows up on every list, but if you didn't do it when everything was going straight up, maybe it's time to do it now. Look at your portfolio and see what happened after this market tantrum, and see maybe it's time that we do some determine if we're on track, if we're in line with our goals. So based on what your current time horizon is or what your current risk tolerance is, should we make some changes? Even if we just plan for those changes when the market comes back into some lineup, that's fine. And planning that makes good sense as well. It's easy to plug accounts into sophisticated algorithms to see, oh, this is what might happen if the market does X, Y, or Z. Real life is a lot better, and that's what we've just seen. So there you have it. You may have asked yourself when you got this email, what kind of planning can we do when the market's down like it is? So I'll tell you, this is one of the most important times to engage and really make some plans. This is about getting your goals and your investments in line, and it's also about going shopping. Are there stocks that you really wanted to own, but 2 months ago you looked at those and said, there's no way that that's a good entry point. So now maybe it is a good time. So again, it's time to accumulate good companies at good prices. Again, it's a little bit more into the Monday video topics, but they all go together for a large part. We'll continue to see volatile markets, and we can hide under our desk and wait till the storm passes over, or we can go out and we can make the most of it. I suggest the latter. So as always, stay in touch, email me, call me, let me know if you have questions. Watch for Monday's market update video, and have a great weekend.